We've had some mentors along the way, but frankly, the only way you can learn any business, whether it's the title business or real estate investing, I think the way to learn is by failing and by doing deals.
Jacob, thanks for coming on today, man. Appreciate you joining us.
Great to be here. Thanks for making the time. I'm excited to talk to you.
Yeah, absolutely. Yeah, so you're one of the co-founders of VanWest Partners. I believe in about 2006-ish. Is that right? Where you started getting into kind of fix and flips. Over your career, you guys have gone from fix and flips to commercial real estate to even to a lot of self-storage, which I believe is most of what you guys are doing today. Tell me a little bit about yourself, your company, and kind of how you got in this world.
Yeah, I've got two little boys that are 5 and 6. They keep us really busy. We felt bad. We got away to Mexico for 3 days and left them with their grandparents. That's the longest trip we've had away from them, both consecutively at the same time. They were not pleased we went to the beach without them. So
I understand.
That's my primary job, and secondary job is real estate investor. And as you pointed out, we got in 2006. I was in my early 20s, no financial training. I was a history major. I was in the fire service. I was flying airplanes for fun and just kind of fell into real estate. And it was a baptism by fire. You can imagine getting in the business in 06 and you're in your early 20s and 08 happens. We learned a lot by failing just over and over again. And I quit my W-2 job around 06 because I wanted to focus on real estate full time. So I've been gainfully unemployed now for, 18 years-ish. So for many years, we focused on value-add residential deals. We buy deals at the auctions, we convert them to rentals, or we fix them up and sell them over and over and over again, mainly in the metro area here of Denver, but all over the country. We were set up in probably 6 or 7 markets consistently, but we would do, kind of onesie-twosie deals in random markets if we bought a portfolio. So that was a good business. And looking back, what we didn't like about it as much is it was very transactional. We were buying and selling kind of too often and too quickly. So we did our first commercial real estate deal in 2014, and it was adaptive reuse retail reposition here in Denver, basically converting an old building into multi-tenant experience-based retail concepts, brewery, restaurant. Did a number of those, did some townhome developments, some multifamily. And then one of our partners who used to work for us, and he partnered with us back in 2014, Wade Buxton, he's like, we should get into self-storage. We said, yeah, let's look into it. So we studied it for a while. We tried a deal out. It was a big development project here in Denver, and it went okay. So we did some more. And over time, we evolved to being primarily and pretty much exclusively a self-storage owner-operator. We still own some retail buildings and some residential around town, but we're mainly a self-storage business.
There's always different opportunities people are interested in. Been hearing self-storage for many years now. So it sounds like you guys were early in that path, right? But I've been hearing private equity, talking, let's call it for the last 5 years. You guys were well before that. Do you think we've hit kind of the end of self-storage making a lot of sense?
Well, I got news for you. It's all hard, right? Wealth creation in real estate is a long, slow game. As far as what the industry is doing, you saw a huge increase in consumer demand coming out of the pandemic, obviously. People were relocating, clearing out the third bedroom. All of us, REITs, smaller operators, everyone in between, saw huge NOI growth, occupancy growth. And really the tale of 2023 was that moderated. You obviously can't keep going vertical. It's really been fairly moderated in 2024 as well. We're still seeing positive same-store NOI growth, but it wasn't at the pace that it was comparing, 20 to 21 or 21 to 22. As far as where it's going, like any real estate asset class, it's so sub-market centric. You could say that self-storage is overbuilt on a national scale, and you might be correct when you say that, but it matters more what you're talking about within the context of a sub-market. Phoenix, for example, in our view, is on the precipice of being supply shocked. A lot of deals are getting built at the same time. We're seeing rents and occupancies go down. It's a supply-demand curve issue. You introduce a bunch of new product, consumers have more options, prices go down, occupancies go down, eventually those fill up. However, in Phoenix, there are pockets where it still might make sense to build or buy an existing facility. Small pockets that are undersupplied. So you could say that it's oversupplied, you could say it's undersupplied, it just kind of depends on what market you're talking about. People inherently, I think, for the foreseeable future, until we have self-driving cars where no one needs a garage anymore because they just get in a self-driving Uber, people just have too much stuff. Our consumer base is surprisingly sticky. Despite the fact they're on month-to-month leases, people will sign up thinking they're going to be there for 3, 4, or 5 months. And 18 months later, after 2 rent increases, they're still paying their rent, still auto-drafting on their Amex card. So people stay longer than they think they're going to, and inherently Americans just need extra space to keep their stuff, and self-storage helps solve that.
It's a good point. I'll throw out here. So at Allied Title, we were looking at some opportunities to do some cost efficiencies over the last couple of years. We have a Christmas tree in a storage unit for the holidays, and we talked about, do we really need a storage unit for a Christmas tree? Well, we were discussing that 3 years ago, and it's still there.
Yeah,
So
and you
it's sticky.
probably could have bought a new Christmas tree every year.
Oh, every
Yeah,
year, easily we could have done
and
that.
there.
But it goes down to also, it's like, oh, it's kind of convenient, and we can put more things, and we'll have it for the future. So
Yeah, I'm guilty of it too. I mean, just one quick vignette on kind of quantifying the fundamental consumer demand in self storage and how consumers behave. We own our office building, and we put a tenant downstairs, an industrial like battery charging tenant. It was vacant for a while. I kept a bunch of my stuff down there, like 12 pairs of old skis, mountain bikes, climbing gear I haven't used forever, camping gear, seasonal gear, family heirloom furniture. Signed our lease with a tenant, and I moved all the stuff into unfortunately a storage facility we don't own about 2 blocks away from our office. And I thought, I'm going to be here for 3 months. I'm going to donate this stuff. I'm going to give some to my sister. I'm going to triage it all. I don't need this for very long. This was probably close to 2 years ago now. I'm still
yeah,
paying $300 a month. My rent has doubled, and I can't find the time to get over there. It's again 2 blocks away, and it's enough to annoy me, but it's not enough to put my financial lights out. So just keep paying the freight, and I could have
Mhm.
bought stuff many times over. But that right there is kind of a characterization of what the typical storage consumer does.
I used to be in the sports and entertainment industries. I used to do obstacle races around the world. We also did New Year's Eve parties with like 3,000 people. And I remember every year we'd buy these like really nice couches for New Year's Eve, and they would cost like $500. You'd rent them for like $1,500 a night. My friend had a furniture business. And so, it's like they cost 500, but you rent them for 1,500. The big cost of that business was storage.
Yeah,
Like it costs a lot. You got all these massive couches, you have to pay for the storage, which is what makes the furniture business expensive. But you have to have it,
yeah,
And
you do.
so you had mentioned, back in the day, you were like mailers, direct mail stuff to get, buy directly off market properties when you first started doing fix and flips, or
Yeah, we
how did you? Or you said auctions too,
Yeah,
right?
it kind of evolved. I wish we could all look backwards and say woulda, shoulda, right, over and over again. But as you know, it was a bloodbath in '08 and the years following. So we were buying deals at the auctions, at the trustee sales,
Yep.
and we were just cleaning up. We were buying stuff for half of what it used to trade for, and then we'd fix them up and sell them just over and over again. And eventually, the secret got out that the auctions in Colorado, we call them trustee sales, but the trustee sales were a good place to buy deals. And the auction room went from 6 or 7 of us in there once a week to like 100 people, and they had to get
Yep.
chairs and change the process up. So eventually that source of deal flow kind of petered out because they were just getting bid up too high. So we pivoted to direct to seller marketing, like I know a lot of your clients probably do, postcards, mailers. We had a sales team signing the contract at the kitchen table, and that's a lot of overhead. You've got payroll,
Mhm.
you've got marketing costs, and buying at the auctions, it's almost no overhead, right? You drive the deals, you pull
Yeah.
title work, you figure out your max bid, and you go out and buy it or you don't buy it. So, we were spending for a while probably 50 grand a month in overhead pretty easily between payroll and marketing. And if one deal makes 25K, you got to do 2 deals a month just to break even. So deal flow was challenging, and we were getting deals. We were still profitable with that line of business. But again, it was just transactional, right? You buy it, you make it better, you sell it, you pay ordinary income taxes, and you do it again. You're eating what you're killing. And our thesis kind of shifted over time to targeting wealth creation in real estate, not by buying and selling, but by buying assets that produce cash flow that are responsibly financed and holding those assets for a while, adding value by operating them more efficiently, then eventually monetizing that value creation in either a sale or a refinance. So yeah, direct to seller marketing was kind of the latter part of our single family careers. And we did apply
Yeah.
some of those tactics to sourcing storage deals. We don't get a lot of them, but we do direct to seller marketing to storage facility owners. Hey, we're not brokers, we're owner operators just like you. We'd love to be able to give you an offer. Give us a call. So we'll pick up a deal or two a year by doing that. So not a lot, but enough to justify keeping it going.
Yeah. And 2014, you mentioned, you got into the commercial space. So when you're making that move from, hey, I've been doing single family, I'm going to commercial, did you have mentors that were kind of helping you along the way?
Yeah, it was more the latter. We've had some mentors along the way, but frankly, the only way you can learn any business, whether it's the title business or real estate investing, I think the way to learn is by failing and by doing deals. You can listen to podcasts, you can read books, you can go to seminars, but there's no better education than actually buying a deal and executing on the business plan for that deal. We get a lot dumber every year. We like to say we're not necessarily smart, but we get less stupid as the years go by. We know what not to do through our breadth of experience over the years and making mistakes, not so much what to do. We probably did a lot of dumb things in 24, and we're excited to be a little less stupid in 2025.
One thing I read about you was you guys have utilized data throughout your career to help, whether it's pick up properties or get better opportunities. What kind of data are you utilizing?
Probably like a lot of companies, we have so much data that we're only beginning to actually make the data that we have actionable, allowing it to create value within our business. So briefly, a couple things that we do. Each storage unit, as I mentioned earlier, is a month-to-month lease, and it's its own product type to a degree. So for example, a 10 by 10 by the front door might command a different price than a 10 by 10 where you have to ride up an elevator and walk 100 feet to the end of the hallway, right? It's still a 10 by 10, but one's going to be much more of a premium because of the convenient location relative to the other unit that's upstairs. We built a scraping software that scrapes all of the asking rates on thousands of facilities around the country. We've had the software running since probably 2015. It scrapes all the data and it caches it away into a database. So we can look back at a given submarket and we can see the peaks and troughs of seasonality. We can see, how a market like in Florida, if a hurricane comes through, we can see what storage rents do, like in the months following the hurricane. We can see the impact of a supply shock when a bunch of deals get built at the same time. You can see those rental rates kind of going down. So that lets us make a more informed acquisition decision when we're underwriting a deal because we can normalize those historic revenue streams. But it also helps us more efficiently operate our portfolio because we get real-time feeds on what competitor rates are doing. So if somebody drops their 10 by 10 rates that's a mile away from us, we know we're probably going to have to follow suit to keep driving our occupancy up because they've got an alternative that's really close by. So that's one example. We've also designed some software systems for investor reporting. We have an API into our property management software. We built this internally from the ground up that allows our investors to log in real time and see any one of 26 different KPIs in our portfolio, like net rental activity, revenue, delinquency rates. So those are a couple of kind of brief examples of a few things we've brought to bear that not only help us run our business more efficiently, but also tell our partners what's happening with their investment with us.
That's impressive. I mean, kind of like we talked about before, you don't want to go tell all your competitors, hey, the auctions are a place to buy, right? But eventually they figure it out. So with those elements of data and the software you guys have created, have you considered ever, although you don't want your competitors to have it, have you ever considered, turning into a software company?
We've thought about it in passing, and I can't say that it's gone anywhere further than thinking about it in passing. We've got almost 90 employees, over 20,000 units. We've got big problems every day in the operational side of the business, unit break-ins, drug issues, theft, people backing U-Hauls into gates. So that's on the list someday of things to kind of consider on how we can monetize what we built. But for the time being, it hasn't gone any further than just kicking it around the conference room every couple months.
When you get busy, look, it's hard to even go into the storage facilities and clean out the $300 a month stuff.
That's right. Yeah. Let me do that first before we monetize the software we built. Let me get my storage unit cleared out. Yeah.
Yeah, the benefits of direct investing versus REITs. Can you kind of tell me, a little bit about that and how you look at that?
Yeah. So if you're listening and you want to be in the self-storage business, you've really got three options. You could buy a publicly traded REIT stock like Extra Space, CubeSmart, Public Storage. You could buy your own storage deal, which means you have to have some capital and some time. You got to figure out how to run it. You got to go get a bank loan. You really got to commit to being in the business before you go out and do that. Or you can invest in private placement offerings with various operators around the country. If you compare and contrast the differences between owning a REIT stock that's traded on the stock exchange versus investing in a private placement, I would say the main benefits of owning a publicly traded stock is you've got liquidity. You can sell your shares, you can push a button, you can get a wire transfer to your Schwab account the next day. However, you're not enjoying the tax benefits of that asset base. Generally, you're getting some cash flow off of it. Some REITs will pay a dividend out, but it's fairly nominal. And you're also at the mercy of external market forces. If generally the market's going up, you might benefit from that. But if the market's going down, the value of your stock might be going down, even though the REIT's performing better than expected potentially. So you're kind of in the mix with a lot of outside factors. The main disadvantage, I would say, to investing in a private placement vehicle is you've got a lack of liquidity. So you can't generally, depending on the structure, you can't generally push a button and get your money back out. You're kind of stuck with the sponsor as a partner for basically as long as they own the asset. But the benefits, though, are fairly material. You get tax advantages. So depending on the offering and the structure, for the most part, the passive loss through depreciation that real estate generates will pass through to you on a K1. And you can use that passive loss to offset other passive gains you might have in your portfolio. And you're also potentially getting more upside. Depending on how the waterfall is structured, you could make a much higher return than you would in a REIT stock, but your main risk and your main downside is you have a lack of liquidity. Those are the three ways you can get into self-storage.
Are you guys offering private placement opportunities at your company, or how
Yeah,
does
we
that
do.
look?
So we've got about $300 million in AUM. Across our 40 facilities. We got a few in the pipeline that we're going to be buying that'll take us up to 41 and 42, probably in Q1. But all of those deals are within that structure. And of our 40 assets, most of those are in one of our three funds. So we launched our first storage fund in 19, and then fund 2 was in 21, and we closed fund 3 up this year. So most of our deals have gone into our fund portfolios. And lately we've been doing single asset deals. And the main difference between a fund and a single asset syndication as it relates to private placements and 506C offerings. In a fund portfolio, it's like you're investing in a mutual fund. You're inherently more diversified. You've got a more diversified geographic footprint. You've got different deal types. But the downside to it is you may want to focus on certain markets with your investing. You may not like, for example, Illinois, and that fund might buy a deal in Illinois, and you might be miffed about that. You can't really do much about it as an investor. Whereas single asset deals, you can kind of pick and choose the locations you're investing. So the last 4 deals that we've done after we closed fund 3, we're in single asset vehicles. So investors can kind of choose which one they want to be in, how much of an allocation they want to make. Maybe they like Georgia, but they don't like Arkansas. They'll make a bigger allocation to Georgia, not Arkansas, for whatever reasons they might be. So those are really the 2 types of kind of private placement vehicles that are out there. And there's plenty of subsets inside of those. But on one hand, you've got funds, which is a collection of assets, and you've got single asset syndications, which is where you're investing deal by deal. It's got its own capital stack, its own LLC, and its own performance metrics. So kind of depends on what you prefer. We do both.
You said you have 90 employees, is that right?
Almost 90, yeah.
So what does the day-to-day look like for you these days? You've been in this industry for, over 20 years. What does the day-to-day look like? Are you spending it on looking at deals? Are you spending it on people problems, or all of the above?
Yeah, the easy answer is all the above. But my typical day, I'm mainly on investor relations, marketing, capital raising, investor reporting, some bank relationships. But I'm talking to a lot of investors. We're answering questions about tax returns. We're introducing people to our offerings. We've got folks who don't even know what an IRR or multiple is, and we've got people who are kind of serial passive investors who are in 20 different funds and syndications, and they're kind of up to speed on all those metrics. Partner meetings, banker meetings, all kinds of stuff. We've got 5 full-time people that are just looking for deals, underwriting deals. And then Clear Home Self Storage is our property management company, and that's overseen by a guy named Scott Smith. He's our director of operations. And the bulk of our employees are inside Clear Home. Our folks at the leasing offices, our regional managers, our on-site managers. So the bulk of our employee count is our operations team that are our boots on the ground out there executing our strategies.
Your background, you were a firefighter. How long were you a firefighter for?
Let's see. I was volunteer for about 2 years and career for about 2 years.
I remember I used to live in San Diego, and I had a good friend. He would try out every year to be a firefighter. I mean, it was so hard to get into. And I mean, he was, really good athlete, and he kept going after it for years after years. Eventually got in, but man, it was so much more harder to get into than I ever could have imagined.
Yeah, I don't know how they let me in, but I took a few tests and did a couple like oral board interviews and did a physical, and I got a job offer, and I was right out of college and didn't really seek it out when I was a kid, but it was something I kind of got into when I was volunteering in college, and I loved it. It was a lot of fun. I left because I wanted to be self-employed and wanted to make my own schedule, and I'm still working on that freedom component. People think that you're a business owner. That's great. Yeah, I'm a business owner, but I've got hundreds of investors, bankers, partners, got all kinds of people that I report to. I think no matter what ship you're steering, you've still got somebody uphill that you're accountable to. So I'm self-employed, but sometimes it doesn't feel like that.
I completely get it. Your company has evolved over the years. Do you feel like we're going to be in the self-storage world forever? Or do you think there's another leg of your company that you guys are working on? You have a team that is looking at acquisitions. Sounds like you're really big into data. Maybe you already know what's coming, down in the future. But can you speak to that at all? Or
Yeah, I wish all my forward-looking statements are wrong, but as far as kind of how we see our business in the years that are coming up, self-storage is very operationally intensive, and to a degree, we're sort of a retail-facing consumer business almost before we're a real estate investment company. We have hundreds of customers moving in, moving out every month. We get customer service issues. It's a whole operation. We built a brand around it. We built a platform around it. We've got a singular focus, but we're also entrepreneurial. And if the storage industry is not working as well, if we're not finding opportunities that meet our risk-adjusted return requirements, maybe at some point we look elsewhere. We've done a lot of different asset classes in real estate. Maybe in a couple of years, multifamily makes sense again. Dare I say, office could be starting to get interesting. Deviation from the mean. You've got shops out there buying these things for a quarter of what they traded for. A 15 or 20-year-old building that sold for $100 million in 19, they buy it for $25 million today. It seems like there's money to make there. Obviously, a totally different business, totally different set of risk profile.
Well, look, I really appreciate you coming on and kind of sharing some of your experience and expertise. Do you have anything else you want to share with our audience?
I would say a lot of people read the books, listen to the podcasts, they go to classes, and they just think and they don't actually take action. My advice would be take action. If you're considering buying a rental property or investing in a private placement, whether it's multifamily, retail, office, storage, the way you create wealth in real estate is with time. And if you're not in the game, you're missing out on that benefit of time. There's no perfect deal. There's no perfect environment to buy in. There's never a good or a bad time to buy. There are deals that lack risk-adjusted returns, and there are deals that have them. So I would encourage everyone listening to go out there and take a risk. It's the only way you're going to learn, the only way you're going to create wealth.
That's great advice, man. Really appreciate it. I know you're a busy guy, and thanks a lot for coming on the show. Appreciate your time, man.
Thanks for having us on today. Had a blast.